Today, we will analyze Kennedy Wilson Holdings, a high-dividend real estate firm that Prem Watsa has a large stake in. For those who are not familiar with Prem Watsa, he is a billionaire value investor who is often referred to as Warren Buffett of Canada. Similar to Berkshire, Mr. Watsa runs a holdings company called Fairfax Financial, a diversified investment empire that includes a large insurance business. He also has an excellent investment record and achieved 18.5% compound annual growth rate since Fairfax's inception in 1985. This means that every dollar invested in this company, the value has grown to around $221 today as of early 2024. So let's figure out why Mr. Watsa is investing in Kennedy Wilson, which I will refer to as KW for short. Since KW is an asset management company, let's start with its historical performance. As we can see below, since its IPO, the total value to shareholders were more than 150%, while its peers only generated less than 50%. And this is despite the fact that KW is undervalued at the moment, and so we can get more than 9% dividend yield by investing in it now. Now let's see what KW does, starting from its official description. Kennedy Wilson is a global real estate investment company. We own, operate, and invest in real estate through our balance sheet and through our investment management platform across the United States, UK, and Ireland. And the firm primarily focuses on multifamily and office properties, as well as industrial and debt investments. And KW currently has about $25 billion of AUM, or assets under management. As the description says, we can divide KW's business into two separate segments. First is consolidated portfolio, which is more like public REITs that permanently owns real estate assets and generates steady cash flow. And the second segment is like a real estate private equity, which raises capital from LPs, invests them into real estate projects, and return investment profit for management and performance fees. In the company filing, the management claims that this dual structure allows KW to enjoy the different benefits of public REITs as well as private equity. So this can be considered the second bullish point of this company. However, this exact situation can also be considered a weakness, because if you look around and see how the market perceives KW, it is not a regular REIT, so it doesn't attract many dividend investors. And on the other hand, it is not an asset-light private equity business that earns high ROEs from LP capital, so it doesn't really appeal so much to investors who would rather invest in pure private equity managers like Blackstone or Brookfield. In order to resolve this issue, we will analyze KW into two separate parts. First, we will see if this can be considered a good dividend-rich investment. And in the second, separate analysis, we will see if KW can be considered a decent private equity firm. Now let's start with the dividend analysis. As we can see here, KW's dividend grew very fast up to 2019. And despite challenging times during the pandemic, its 10-year dividend growth rate was 13% per year. Also, during the most recent conference call, the firm's CEO clearly stated that even though KW is not a REIT in a legal sense, the management considers the dividend as a very important form of shareholder return and one of key priorities for the firm. But despite such solid dividend, KW's stock price lagged recently because of its real estate composition. For instance, although multifamily is more than half of its assets, office takes up almost 30%. And as you probably know already, office has been one of the most challenging real estate subsectors since the pandemic. If we look at the details of the office properties, the fact that a lot of them are located in Ireland and UK, and also the fact that they tend to be high-quality properties, are mitigating factors for KW. But currently, the stock market discounts any asset related to the office real estate. Also, the fact that most of KW's American real estates are located in the western region, including California, is also worrying the market about the health of KW. For example, the San Francisco region was hard hit by the cooling of tech sector, and many companies are leaving the downtown area, where KW also owns some offices. Although the overall occupancy rate of KW's real estate portfolio is not so bad at 94.4%, its falling trend is causing a discount on KW for sure. Of course, there are additional factors to consider when analyzing a REIT. But for this company, other factors like NOI, cash flow, liquidity all look pretty decent. And as you can see here, the debt structure and real estate risks are all pretty well maintained. So now let's move on to the second part of the business. For the private equity, let's start with a qualitative analysis. For most companies, and especially for asset management business, the insider incentives are very important to avoid moral hazard and also to attract high-quality investment professionals who should get paid well when they make good investments. And in this regard, KW has an excellent position. It has the usual annual bonus scheme and also long-term incentives where bonuses are tied for 3 years. So even if 1-year result is good and the managers get paid well, the ultimate payment amount will depend on 3-year compound rate of return. Also, the investment professionals at KW have mandatory minimum ownership requirement. This is great because if the insiders are also shareholders, they share the same pain and gain alongside shareholders. Also, the top management has much more shares than this minimum requirement, and their ownership adds up to 23.7%, which is quite high. And we believe this alignment of interest is one of the key factors behind KW's outperformance that we saw before. This resulted in shareholder-friendly measures like the stock repurchases. As we can see here, KW's buybacks, which is shown in red, is comparable to the green bars, which is the consistent dividends. Also, KW takes advantage of credit market fluctuations and bought back its debt when it traded at a significant discount in the public markets recently. Another important aspect of KW is the role of Fairfax Financial Holdings, the company managed by Prem Watsa that I explained before. Because Fairfax is not just one of the shareholders, but rather the largest shareholder, as we can see in this table. In addition, Fairfax began to get involved in the management as Wade Burton, a CIO of one of the Fairfax subsidiaries, joined the KW's board in 2022. This is important because Fairfax is also big in its insurance business, which means it has a large sum of money to deploy. And as the tie between Fairfax and KW strengthens, Fairfax is investing more and more money through KW. As a result of this relationship, KW's fee-bearing capital, which is one of the most important drivers of private equity growth and profit, is growing at a fast rate. For example, just about a year ago, the capital was $5.3 billion, but it's grown to $8.2 billion, with $3.2 billion in pipeline of capital recently. As we can see in these graphs, more than half of this capital is coming from Canadian insurance companies, which of course includes Fairfax. Since the close tie with Fairfax just got deepened in 2022, we believe this relationship and capital trend will continue for years down the road and will make KW much more profitable real estate private equity firm. However, regarding the private equity business, I felt like KW provides only limited information in terms of exact long-term IRR as well as the fund structures. This is definitely a downside for an outside investor, and I hope the disclosure follows other listed private equity firms' standard, like Blackstone, and this clarity will help KW's valuation go up. Okay, so that's it for my analysis on KW. It was definitely an interesting case, because a famous value investor is not just a shareholder, but a party with much more meaningful relationship with the firm. And it would be interesting to see how KW evolves with Fairfax's backing down the years. All the while, we enjoy the 9% dividend yield. Thank you for watching this video, and please feel free to share your feedback and opinion on KW. Thanks guys.